Most retirement plans are built to handle all the usual suspects, right? Market swings, inflation, even the fact that we're living longer. But what if the single biggest threat to your financial future isn't in your portfolio, but it's actually in your own head? That's the hidden risk we're going to dive into. So let me just ask you straight up. When you think about what could mess up your retirement, what's the first thing that pops into your mind? A big market crash, maybe? Sky-high inflation? Well, it turns out the real threat might just be looking right back at you in the mirror. Nope, it's not the charts and numbers flashing red and green on our screens. Now look, market volatility and inflation, they absolutely matter, don't get me wrong, but they aren't the primary thing that sabotages a really solid plan. The real culprit is something much, much closer to home. That's right. It's us. It's our own emotional reactions to all that market noise. The fear we feel during the downturns, the greed we get during the rallies. These are the behaviors that cause us as investors to completely undermine our own long-term goals. So the question is, how do we actually measure the cost of making these mistakes? Well, this isn't just some vague idea, It's a well-studied concept in behavioral finance, and it has a specific name. And understanding it is really the first step toward conquering it. So, picture this. Your investment portfolio is designed to earn, let's say, 8% over the long haul. But because you panic sell when the market dips and then you wait too long to buy back in after the rally, you only end up with, say, 5%. That 3% difference, that is the behavior gap. It is literally the price we pay for being human. And that gap, it's not just a hypothetical. There's a famous study from a company called Dalbar that found for 30 years, the average equity investor underperformed the S&P 500 by a margin just like that, costing themselves several hundred basis points. We're talking multiple percentage points every single year. That is a massive drag on your wealth, and it's caused almost entirely by our own behavior. So what's driving this? Well, it boils down to a few key cognitive biases that are just wired into our brains. You've got loss aversion, where a 10% drop hurts way more than a 10% gain feels good, which leads to panic selling. There's recency, where we completely forget our long-term plan just because the market's been down for 3 weeks. And of course, confirmation bias, where we only look for news that tells us our panic decision was the right one. Our brains are practically hardwired to work against our portfolios. Now, as challenging as these biases are throughout our lives, they become exponentially more dangerous during one specific period, that high-stakes decade right around your retirement. Experts actually call this period the fragile decade. It's that time just before and right after you stop working. So why is it so fragile? Well, it's because you're making a massive shift from accumulating money to actually spending it. And that introduces a whole new level of psychological pressure. And this psychological pressure, it has a name: decumulation anxiety. It's that nagging fear that your nest egg isn't going to last. I mean, without that steady paycheck coming in, even the most seasoned investors can feel vulnerable, which makes them way more likely to make emotional, short-sighted decisions. And we can see this anxiety playing out in the data. A Schroeder survey found that of all the people in retirement plans holding a ton of cash, more than half do it for one simple reason: they're just afraid of market losses. This is loss aversion in action. People sacrificing long-term growth for what feels like short-term comfort. And it's not just our internal emotions. There are external pressures too, what Goldman Sachs calls the financial vortex, and it just sucks people in. Things like debt, high expenses, caregiving costs. This vortex has disrupted the savings of over 60% of Americans, basically adding fuel to that psychological fire. Okay, so if our own behavior is the biggest risk, what on earth is the solution? Well, the source material here argues for a really big shift in how we think about financial advice. It's less about being a market guru and way more about being a behavioral coach. This comparison just makes this shift crystal clear. A traditional advisor, they manage the money. But a behavioral coach, they help manage your behavior with the money. They act as an emotional stabilizer, and their focus isn't just on portfolio returns, but on your ability to actually stick with the strategy through thick and thin. So what does this kind of coaching look like in practice? Well, it involves some really specific tools and techniques, all designed to help you avoid becoming your own worst enemy. The first, and maybe the most important, technique is to completely change the conversation. Instead of obsessing over market returns, the whole discussion is grounded in your personal values and your life goals. The question becomes, how does this plan help you live the life you want? Not, hey, how did the S&P 500 do this week? It's a game changer. A really powerful tool for this is called flooring. The goal here is to build a foundation of guaranteed income, from things like Social Security or maybe annuities. to cover all your essential expenses, your mortgage, food, healthcare. When you know your basic needs are met no matter what the market does, man, that is a profound antidote to financial anxiety. Another great strategy is bucketing. This is where you divide your money based on when you'll actually need it. So you'll have a cash bucket for the next couple of years, which means a market downturn doesn't affect your daily life at all. It's kind of a mental accounting trick, but it helps you see that while some of your money is at risk, the money you need soon is totally safe, and that helps prevent panic. Now, beyond these big frameworks, a good coach is proactive. They're going to schedule check-ins during volatile times, not to talk about performance, but to remind you of your long-term plan. They might even use personality assessments to understand how you process risk, so they can tailor their communication to be exactly what you need to hear, whether that's cold, hard data or just some emotional reassurance. So what does all of this mean for you? It means that building a truly robust retirement plan requires a new perspective. It's not just about finding the best investments anymore. It's about building the best defense against your own worst instincts. This quote from the source material really just says it all. A brilliantly designed high-return strategy is completely worthless if you jump ship at the first sign of trouble. The best plan isn't the one with the highest potential return on paper, it's the one you can actually stick with. And that leaves us with one final question to think about. I want you to look at your own retirement strategy. Is it just a collection of assets designed to weather a market storm? Or is it a thoughtful plan with behavioral safeguards built right in, designed to help you weather your own emotional storms? Because at the end of the day, managing yourself might be the most valuable financial skill you can ever learn.